ready to unlock some market secrets. Today, we're diving deep into Joel Greenblatt's magic formula for investing.
Sounds intriguing.
We've got 2 articles and a website summary all about his book, The Little Book That Still Beats the Market. Our mission: figure out if this formula really lives up to its name.
Well, the book's been around for a while, originally published back in 2005 and updated in 2010, but it still seems to be super popular. People are always looking for that edge.
Absolutely. Everyone wants that secret sauce for investing success.
Mm-hmm.
And our chef, in this case, is Joel Greenblatt, right?
Right.
So who is this guy, and can we trust him with our hard-earned money?
Well, let's just say he's not some random guy with a blog. Greenblatt has actually achieved incredible success as an investor.
Oh, yeah. Like what?
He started a firm called Gotham Capital, turned $7 million into over $350 million in just 9 years.
Whoa, hold on. That's like a 40% return every year. Okay, now I'm listening.
Exactly. And he's not just some Wall Street hotshot either. He's a professor at Columbia, teaches value investing.
All right, so the guy clearly knows his stuff, but I'm guessing his strategies are probably super complicated, only for the super rich.
Actually, that's what's so interesting about Greenblatt. He believes that anyone can beat the market, not just the pros.
Now that's a bold claim. So tell me more about this magic formula. What's the secret sauce?
It's all about finding those hidden gems, those undervalued stocks with high earning potential. Think of it as bargain hunting, but in the stock market.
Okay, I like where this is going. But how do you actually find those bargains?
It all comes down to 2 key financial ratios: return on invested capital, or ROIC, and earnings yield. The formula ranks companies based on these, and you buy the top 20 to 30, hold them for a year, and then rebalance your portfolio.
So it's a pretty systematic, almost mechanical way to invest. Buy low, sell high, but with a specific formula guiding you.
You got it. And the logic behind it is based on the idea of exploiting market inefficiencies. Remember Benjamin Graham, the father of value investing?
Oh yeah, Mr. Market and all that.
Exactly. Greenblatt's building on that idea, arguing that emotions often lead to mispriced stocks. So by systematically finding good companies at bargain prices, you're tilting the odds in your favor.
So you're basically taking advantage of Mr. Market's mood swings.
Mm-hmm.
Buying when he's panicking, selling when he's overly optimistic.
Precisely. And Greenblatt claims that this approach, done consistently, can really lead to significant returns.
All right, let's talk results. Does the data actually back up his claims? Does this magic formula really work?
Well, Greenblatt backtested the formula's performance from 1988 to 2004, found an average annual return of over 30%, way higher than the S&P 500's average of 12% during that same period.
30%. Okay, that's impressive. But of course, past performance doesn't guarantee future results.
Of course not, but it's definitely compelling evidence.
It is. But one of the articles you sent over, Emily Lai's piece, seems to be a little skeptical. They lean more towards that set it and forget it passive investing approach.
Yeah, and that's a valid point. There are different engagement styles for different people. Lai's approach definitely highlights that.
So no one-size-fits-all solution. The best way depends on your risk tolerance, goals, that kind of thing.
Exactly. And even Greenblatt himself points out that this formula can underperform in the short term. He really emphasizes that patience and discipline are key here.
That makes sense. So for someone intrigued by this whole magic formula idea, how would they actually put it into practice?
Greenblatt's made it surprisingly user-friendly. He actually has a website, magicformulainvesting.com. You can access the formula, generate a list of potential stocks.
So you're saying he's basically taken all the guesswork out of it?
Not quite. You still need to understand the steps involved. You'll need to set a minimum market capitalization, like at least $50 million, to avoid those tiny, volatile companies.
Okay, so bigger companies, got it.
Then you pick at least 20 stocks from the list the formula spits out, buy them, and hold them for at least a year. This helps you benefit from those lower long-term capital gains tax rates.
Got it. Diversify, be patient, let the formula work its magic. Sounds pretty straightforward.
It is, in theory, but remember, you'll have to rebalance your portfolio after that year. Sell some, buy new ones based on the updated rankings. Greenblatt even mentions a more frequent rebalancing strategy, like every few months, but that gets way more complex.
So even with a magic formula, there's still some work involved, some active decisions to be made. It's not completely hands-off.
Right, and that's where those potential challenges and limitations come in. It's important to think critically about those.
Okay, I'm all ears. What are some of the potential downsides? What could go wrong with this strategy?
Well, first off, volatility. Greenblatt's upfront about that. This strategy can be bumpy, especially in the short term, so investors need to be prepared for that.
So not for the faint of heart or those looking for a quick buck. Got it. What else?
Well, there's also the issue of diminishing returns. The more people pile into this formula, the less effective it might become.
Ah, so it's like a secret fishing spot. Too many people show up and the fish disappear. Makes sense. Any other limitations we should consider?
Well, some argue that using only those two financial ratios might oversimplify things a bit.
In what way?
You might miss some crucial things about a company, like how good their management is, their competitive landscape. Those aren't reflected in just the numbers.
So the formula is a good starting point, but you can't just blindly follow it without understanding the actual businesses.
Exactly. And that's a point that Euclidean technologies, one of the sources we're looking at today, really emphasizes.
Oh, yeah, Euclidean technologies. They're taking this whole concept to another level, right? From what I've read, they're refining Greenblatt's ideas with a more systematic approach.
They are, and they actually share Greenblatt's core belief in value investing, but believe incorporating more factors could lead to even better results.
Okay, hold on. This is getting really interesting. Tell me more.
Well, they look beyond just ROIC and earnings yield and dive deeper into evaluating the character of a business.
Character, like, is this company trustworthy? That kind of thing.
Yeah, kind of. They look at things like growth rates, dividends, how strong their balance sheet is, and even how the market feels about the company.
Wow, that's a lot to consider. So Euclidean Technologies is basically adding turbo boosters to Greenblatt's magic formula.
In a way, yes. And it shows how much influence Greenblatt's work has had. He's really sparked a movement of investors who are taking his ideas and making them even better.
That's fascinating.
Yeah.
This magic formula is turning out to be a lot more than just a simple formula. It's a whole new way of thinking about investing.
Exactly.
And if the market is truly as unpredictable as Greenblatt and Graham suggest, who knows what other opportunities might be out there? Maybe we can find those undervalued companies and really beat the average investor.
Maybe we can.
That's a thought-provoking question for sure. But for now, let's take a breather and recap what we've learned so far about Greenblatt's magic formula.
Sounds good. There's a lot to unpack.
All right, so Joel Greenblatt, definitely a big name in the investing world. He's got that incredible track record, a passion for making investing less complex. His magic formula, it's all about finding those good companies, those undervalued ones, with that high return on invested capital and high earnings yield. The data is pretty impressive, but of course it's got limitations and requires patience, discipline. It's not a get-rich-quick scheme.
Right. And remember, we also talked about those other perspectives on investing,
Yeah.
like Emily Lai and her preference for that passive investing approach. And then you've got companies like Euclidean Technologies taking Greenblatt's ideas to a whole new level.
Exactly. So many different approaches to consider. This magic formula, it's a valuable tool, no doubt, but it's just one piece of the puzzle when it comes to smart investing.
Couldn't agree more. It really is. And, speaking of different approaches, one of your sources, Emily Lai's article, mentioned this interesting concept, the margin of safety.
Oh, yeah, I remember that. Isn't that a classic value investing principle? Kind of like buying something on sale, getting that extra discount.
Exactly. You're buying stocks for less than their true worth. And it actually ties in perfectly with Greenblatt's magic formula. Remember that earnings yield we talked about?
Yeah, that was one of the two key ratios in the formula.
Right. That helps you find stocks that are trading at a lower price compared to their earnings. So you're inherently building in that margin of safety.
So if a company's earnings are good, but the stock price is low, that's a good sign.
It could be. It might mean you're getting more bang for your buck, buying $1 worth of earnings for, say, 80 cents.
Makes sense. But how do you even figure out a company's true value? Isn't that super subjective?
It can be. There are a lot of different ways to value a company. But remember, Greenblatt's all about simplicity. He's not trying to be super precise. He's just looking for those companies that are clearly undervalued based on those two key ratios.
Okay, so it's more about spotting those screening deals, those companies that are so obviously underpriced that you don't need to be a math whiz to see it.
Exactly. And that's where the margin of safety comes in. Even if your valuation's a bit off, you're still getting a good deal. It's like having a buffer, reducing your risk.
Yeah, like a safety net for your investments. I like that. So it's not about being a perfect stock picker. It's more about tilting the odds in your favor, finding situations where the potential reward is much bigger than the risk.
Exactly. And Greenblatt really stresses that this formula works over the long term. You have to be patient. There will be times when it underperforms, maybe even times when it seems like the market's ignoring those undervalued companies. But he's convinced that eventually things will even out.
So it's like planting a garden. You got to be patient, wait for those seeds to sprout and grow.
Perfect analogy.
But I imagine there are moments of doubt, like, is this thing really working? Am I doing this right?
Oh, for sure. Everyone goes through that. But if you really understand why this formula might work, that the market can be irrational, that emotions can lead to mispricings, you'll be more likely to stick with it, even when things get rough.
Makes sense. It's about having that deeper understanding, that belief in the strategy.
Exactly. And don't forget, Greenblatt's not promising overnight riches. He recommends holding stocks for at least a year. This gives the strategy time to work, plus you get that tax advantage.
Right, got to be patient, play the long game. But we touched on this earlier. There are different ways to use this magic formula, right?
Yeah.
Like rebalancing every year versus every few months.
Yep. Greenblatt actually thinks rebalancing more frequently might be even better, closer to how the formula is designed to work. But of course, it's also more work.
Ah, so there's a trade-off. Higher potential returns, but more complexity.
Exactly. You got to find what works best for you, your time, your comfort level. Greenblatt's main point is to be consistent and disciplined no matter which approach you choose. He thinks a lot of investors get tripped up by being impatient, letting their emotions get in the way.
Ah, so it's about outsmarting those emotional investors, those who are constantly reacting and making rash decisions.
You got it.
All right, so we've talked about the good stuff, the potential of this magic formula. But let's be real. What about the potential downsides? Every strategy has its weaknesses, right?
Absolutely. It's important to acknowledge those.
So spill the beans. What could go wrong with this magic formula?
Well, one thing Greenblatt himself mentions is those diminishing returns. Remember we talked about that secret recipe losing its magic if too many people use it?
Oh, yeah, like that fishing spot getting too crowded.
Exactly. If everyone jumps on the same bandwagon, it might not work as well.
Interesting. So the formula's own success could potentially be its downfall.
It's possible. But to be fair, Greenblatt's book came out almost 20 years ago, and people are still using the formula with decent results.
Okay, so it's held up pretty well so far. But are there any other limitations we should be thinking about?
Well, some people argue that those two ratios, the ROIC and earnings yield, just don't tell the whole story. It's like judging a book by its cover. You might miss some important details about the company, like how good their management team is or what the competition looks like. Those things aren't always reflected in the numbers.
Right, so you can't just blindly follow the formula. You got to do your homework, really understand the businesses you're investing in.
Exactly. And that's something that Emily Lie's article really highlights too. The magic formula is a good starting point, a way to find potential investments, but you gotta do your due diligence.
It's like having a metal detector. It can help you find where to dig, but you still got to do the digging yourself. See if there's actually treasure buried there.
Love that analogy. And it all comes back to thinking critically, using your own judgment. There's no one-size-fits-all solution in investing. The best approach depends on you, your goals, your risk tolerance.
Right. What works for one person might not work for another. Makes sense. But, speaking of taking things further, we were talking about Euclidean technologies earlier.
Right.
They're really pushing the boundaries of what's possible with this whole systematic investing thing.
Definitely. And they're a great example of how impactful Greenblatt's work has been. He's inspired all these investors to build on his ideas, develop even more sophisticated strategies. It's amazing.
It's like he laid the groundwork, and now others are building these incredible structures on top of it. So cool.
Exactly. And, it raises an interesting question. If the market is truly as irrational as Greenblatt and Graham say it is,
Yeah.
what other opportunities might be out there? What other ways can we find those undervalued companies and really outperform the average investor?
Ooh, good question. I love it when a deep dive leaves us with even more questions than answers, keeps those wheels turning. But Emily Lie's article brought up another really important concept in value investing that we should talk about. The moat.
Oh, yeah, the economic moat. That's crucial. Think of it like a company's defensive barrier.
Protecting them from competitors.
Exactly. It's what gives them an edge, helps them keep making those profits.
Makes sense. But how do you actually spot a company's moat? What should we be looking for?
Well, there are a few different kinds of moats.
Okay, I'm ready to take notes.
Okay, so one of the most common is brand recognition.
Like Apple or Nike.
Mhm.
Their brand name alone is worth a ton.
Yep. People are willing to pay more for a strong brand than there are network effects.
Ah, the bigger the network, the better. Like Facebook or Instagram.
Right. Then you've got cost advantages.
Like Amazon, right. They're so huge they can offer super low prices that other companies just can't compete with.
Exactly. Then there are switching costs.
Ah, those are the tricky ones, right? Like,
Yeah.
once you're using a certain software, it's a pain to switch, even if there's a better option out there.
Yep. It locks customers in. And finally, there's intellectual property.
Right. Patents, trademarks, all that legal stuff that protects a company's inventions.
Exactly. So when you're looking at companies, try to figure out what their moat is, what makes them special, what protects their profits.
Sounds like finding a company's moat requires some serious detective work.
It does. And that's one area where the magic formula might fall short. It doesn't really take those qualitative factors into account.
So even if a company looks great based on ROIC and earnings yield, you still got to make sure their moat is solid. It's not just about the numbers.
Right. A company might have great numbers today, but if their moat is weak, those profits could disappear quickly.
It's like buying a house that looks great on the outside, but has a leaky roof and bad plumbing.
Exactly. You got to look under the hood, so to speak. And that's where Euclidean technologies really shines. They go beyond just the numbers.
Right. They're looking for those companies that are not only undervalued, but also built to last, with those strong moats to protect them.
They are. It's a really smart approach, combining that quantitative analysis with a deep understanding of the businesses themselves.
It's like having a map and a compass guiding you to those hidden treasures.
Exactly. It really is. It's like you said, tending a garden. You plant those seeds, but you got to keep nurturing them if you want to see them grow. You got to water, weed, prune, all that good stuff.
Exactly.
Yeah.
You can't just plan to forget. And rebalancing is a good time to kind of step back, Make sure your investments are still working for you, that they're still aligned with your goals.
Definitely. It's all about making sure your money's working for you, helping you reach your financial dreams, not just sitting there doing nothing.
Absolutely. So we've talked about diversification, rebalancing.
Yeah.
Those are two key tools in our investor toolbox. What else should we keep in mind? Any other pro tips you can share?
One thing that a lot of people don't talk about is the importance of controlling your emotions.
Oh, that's a big one. The market can be a real emotional roller coaster.
It really can. And those emotions can lead you to make some bad decisions.
Yeah, like panic selling when the market dips or chasing after those hot stocks everyone's talking about.
Exactly. But the thing is, the market is driven by emotions, and those emotions can create these wild swings that don't really reflect the true value of things. If we can learn to keep our cool, not get swept up in the fear and greed, we'll be in a much better position to make those smart, rational decisions.
So it's like being the eye of the storm, staying calm and centered while everything's swirling around you.
Exactly. And that's where having a solid strategy like the magic formula can really help. It gives you that framework, those guidelines to follow, even when things get crazy.
Okay, so it's not about being a robot, completely ignoring your feelings. It's more about having a system in place to help you make those rational choices, even when you're stressed out or feeling impulsive.
Well said. It's about using those emotions in a positive way, channeling them to fuel your discipline and your determination to stick with your plan.
Love that. It's like being the captain of your ship, guiding it through those rough waters instead of letting the waves toss you around.
Exactly. And, Greenblatt talks a lot about this in his book. He really believes that our biggest enemy as investors is often ourselves,
What do you mean?
our emotions, our own biases, and those little mental tricks our brains play on us.
Ah, so we got to be aware of those too, not just our emotions. But biases, those are a little trickier to spot, right?
They are, but they can really trip us up. It's like those blind spots, We think we're seeing the whole picture, but these biases are distorting things without us even realizing it.
Okay, so what are some of these biases we should be watching out for? What are the big ones?
Well, there's confirmation bias. That's the tendency to look for information that supports what we already believe, even if that information isn't really accurate.
Ah, so it's like only listening to people who agree with us,
Yeah.
even if they're wrong.
Exactly. And it can be really dangerous because it stops us from seeing the whole picture, those potential risks and problems.
Okay, confirmation bias. Got it.
Yeah.
What else?
Then there's recency bias. That's where we give too much importance to recent events, even if those events aren't really a good predictor of what's going to happen in the future.
So like if the market's been doing great lately, we assume it'll keep going up forever.
Exactly. Or the opposite, if the market's been down, we assume it's never going to recover. We get caught up in the moment and forget about the bigger picture.
Right. Those short-term swings can be really misleading. Okay, recency bias, check. Anything else?
One more big one is loss aversion. That's the tendency to feel the pain of a loss much more strongly than the pleasure of a gain.
Ah, so like losing $100 hurts way more than finding $100 feels good.
Exactly. And it can really mess with our decision making. We might hold on to losing investments for too long just to avoid the pain of selling them. Or we might sell winning investments too early because we're afraid of losing those gains.
So it's like those emotions are hijacking our brains. Okay, loss aversion. Got it. Got to be aware of that one. Any other words of wisdom to help us fight these biases?
The most important thing is to just be aware of them. Recognize those patterns in your thinking and try to make those more objective, rational decisions. It's like having a little checklist in your mind before you make any big investment moves.
Right. Am I being influenced by confirmation bias? Am I overreacting to recent events? Is loss aversion clouding my judgment? Those are good questions to ask ourselves.
Exactly. The more aware we are of these biases, the better we'll be at avoiding those costly mistakes.
This has been an incredible journey. We've really uncovered a treasure trove of knowledge, not just about Greenblatt's magic formula, but about investing in general. I feel like I've leveled up my investing game.
I'm glad to hear that. And remember, this is just the beginning. The world of investing is constantly changing, so it's all about continuous learning.
Absolutely. Never stop learning, never stop growing.
Yeah.
So as we wrap up, what are some of the key takeaways our listeners should remember? Those essential nuggets of wisdom to guide them on their investment journey.
Okay, so first, the magic formula is a great tool, but it's not a guarantee. It's a starting point, a way to find those potentially undervalued companies, but you got to do your own research.
Right. Don't just blindly follow the formula. Understand those businesses you're investing in.
Exactly. And second, investing is a long game. You got to be patient, ride out those ups and downs, and not get spooked by those short-term fluctuations.
Patience and discipline, those are key. Like we
Yeah,
said earlier, it's like planting a garden.
it is. And lastly, don't forget about those emotions. Learn to control them, recognize those biases, and make those rational decisions based on those solid principles.
Right. The market will test you. It'll try to throw you off course. But if you stick to your plan, stay focused on your goals, you'll be in a much better position to succeed. So to our listeners, happy investing. It's a fascinating journey, a lifelong pursuit of knowledge and growth.